There's only a couple months left in the year, and time is running out to complete your year-end tax planning to control your tax liability. The common ideas or suggestions given to reduce your taxes in the fourth quarter are to max out your 401k or small business retirement plan, but those tax deferral strategies may give you very little relief. If you made a significant amount of money this year and you've been looking for ways to reduce your annual tax liability, and most importantly, you are charitably inclined, consider creating a charitable lead trust to potentially receive a significant and immediate tax reduction. But it's important to know that the trust needs to be established and funded by December 31st if the intention is to take the deduction in the current year. First, let's start with understanding what a charitable lead trust is. A client donates an asset to the charitable lead trust in which the charity receives an amount of income for a specified term of years. And at the end of the term of the charitable lead trust, it stops paying the income to the charity and the asset is returned to the donor if they're still alive, or the donor's non-charitable beneficiaries would get the asset, such as spouses, children, or even grandchildren. The tax benefits may vary, however, depending on how the trust is established. If the intention is to create an immediate tax deduction, though, for the current year, like I mentioned before, the trust must be established as a grantor charitable lead trust. In a grantor charitable lead trust, the grantor can take an immediate deduction based on the present value of the future income stream, and the amount of the deduction will vary depending on whether the donation was made to a public or private charity. Donating assets to a public charity, though, may offer a larger immediate income tax deduction. Additionally, any unused portion of the deduction in the first year can be carried forward for the next 5 years. It's also very important to know the income generated from the trust is taxable to the grantor during the term of the gift because the grantor still remains, has a retaining interest in the property, and they will receive that asset in the future for their personal use down the road. But ideally, you want to donate assets like cash, bonds, or bond funds, any asset that has little to no appreciation. So let's take a look at an example of the grantor charitable lead trust. And this is all hypothetical here. Mike, who's 60 years old, is charitably inclined, and he has no need for current income, and he earned a very significant amount this year. He decides to create a $1 million grantor charitable lead trust that will pay the local Boys and Girls Club $55,000 annually for the next 10 years. Based on the current assumptions, the current income tax deduction would be approximately $485,000, and Mike could use that against his current income, which is subject to the charitable deduction limits. So if we were to assume as well an 8% return on the investment, Mike would receive about $1.3 million at the end of 10 years. A charitable lead trust can be a very flexible, tax-efficient vehicle tailored to the needs of high-earning, wealthy individuals or families. And it allows a donor to transfer an asset to a charity of their choice for a specified number of years before it reverts back to the donor or donor's beneficiaries. So if the donor's objective is to reduce their current income taxes this year, a grantor charitable lead trust would make a lot of sense. But with only a couple months left in the year, you must act now. Schedule a consultation with me to talk more about the charitable lead trust to see how it may fit into your personal, financial, and estate plan.